Hello and welcome to Pitch the PM. My name is Doug Garber, and I'll be your host for our second episode. Today, we'll be discussing Pool Corp, ticker POOL. Berkshire recently bought a 1% position in this company, and today we're going to take a deep dive. Today, I am reverse engineering Berkshire's thesis to understand their process in real time and follow along with their thesis. This is a exercise I do to improve my process. It's also something that Pabrai does. He reverse engineers a lot of other people's great ideas. And this is a stock that I've known for a long time. I know practice isn't something a lot of people do a lot. I know this little clip here from AI or Alan Iverson has his own view on practice, but I do believe it's important. And we'll just watch this clip because I think it's entertaining.
When you just talk about practice, we sitting here, I'm supposed to be the franchise player, and we're in here talking about practice. Well, Coach, I mean, listen, we talking about practice. Not a game. We talking about practice.
Since I went through this whole exercise and spent a week reverse engineering this, building the model, going through the exercise to try to understand how the Berkshire portfolio management team thinks when they buy a stock. So this is a great company in a lull, and they're likely betting on a return to what was historical growth in the 10 to 20% growth range. I put this together with the help of my sponsors, Indink Analytics. I use their dedicated analyst team. And if you want a copy of the model that we built together, just email learn@pitchthepm.com. I also used AlphaSense as a partner to their research, just made everything much more efficient in terms of gathering the research and doing the time. They cut my time probably in half from collecting filings and doing competitor and industry research. And their library was very instrumental in following along what's going on in the industry in real time and creating a variant view versus what management's saying. Using their library, you are able to get ahead of the industry trends before it comes out. And you'll see we'll do a case study at the end of this that shows using the TGIS library how you're able to essentially figure out that the stock's going to be available at a cheaper price in the near future because management has said that the industry is going to be flat. And then if you just do your checks and do your homework and follow along with the experts in the library or even do your own calls, you'll realize that the industry was doing a lot worse. But we'll dig into that later. Today, we're going to go through our 8-step checklist that mimics the questions that I believe the Berkshire team would ask. They keep it pretty simple, so it's a little bit shorter than the 10-step variant view process I use in most of my other episodes. So we'll get started. Here's the checklist so we can all review it together. Is this business in my circle of competence? Is the stock available below intrinsic value? Does Berkshire have a potential variant view? Does the business operate in a good industry? Is this a bad, good, or great business? Does the business have a wide moat? And are management incentives aligned with owners? And at the end of the day, is this one of your 20 lifetime purchases or punch cards that Buffett says, only make 20 stocks? Only if you're only to buy 20 stocks in your whole life, would this be one of them? So a little overview of this stock. So Berkshire disclosed a 404,000 share position at the end of Q3. That's valued at about $140 million today. It's about 1% of Pool shares outstanding. Overall, this is a tiny position for Berkshire's $300 billion equity portfolio, or 0.05%. And my sense is this is most likely owned by Ted or Todd. Berkshire or Warren Buffett really only does much larger positions at this point. Now, both of those portfolio managers have an amazing track record, but they do embody the spirit and the principles that Buffett has used. So it's about a $346 stock. It's about a 13.2 billion market cap, about a 14 billion enterprise value. It trades about 300,000 shares a day, or close to about 100 million of value a day. So pretty liquid stock there. And this is the 1-year stock chart you'll see. And my sense is by looking at the timing of when Berkshire filed on 9/30 versus what the stock did in the third quarter. They had a pre-release at the end of the second quarter, and then the start of the third quarter, the stock was really low, broke $300 a share. As my sense is, Berkshire does research on great companies, and they just sit there and wait for the price to be attractive. And that's likely what they did here, saying, hey, the company pre-released and it's still a great company. I know they might have missed expectations and the company rebounded. And that's might be why they have a relatively small position overall, because it didn't stay in the low 300s for very long. And the next question is this business in my circle of competence? We do a quick business snapshot of the company. Pool is a wholesale distributor of swimming pool supplies, equipment, and chemicals. They also do a little bit of landscape products and irrigation, but it's mostly wholesale. It's B2B. They do a little bit of retail to the do-it-yourself pool owner. Over 90% of their business is in the US. They do a little bit in Europe and a little bit in Australia. And for me, this is in my circle of competence. One, I recently built a pool and I'm a consumer of a lot of these products. So I'm familiar with the equipment and the chemicals needed and just the overall business model of the pool industry. Plus, this is a company I've been a professional investor in. I covered it at Millennium as a senior portfolio manager. I also have known this company for 20 years. Even as a student, when I was at Tulane, we covered local companies in stocks under rocks from Berkshire Reports. And this was in Covington, Louisiana, so pretty close to New Orleans. And it's a really relatively simple business model. So most people could understand it. But before you invest, you want to make sure you understand the business model and what a wholesale distributor in the pool business does. They're selling everything from the chemicals that you need every week to maintain your pool, to the replacement of the pool pad equipment, which is getting bigger and bigger, to all the other equipment you need for your pool. And there is some new construction. There's some remodel and repair and maintenance stuff there. And then there's the day-to-day stuff. So the next slide is Buffett looks at this pretty early on is what is my margin of safety? He doesn't want to lose money. His rule is rule number one, don't lose money. Rule number two, refer to rule number one. So, in my process, in the Variant View, the 10-step process, I do this much later on. That's kind of how I developed it. He looks at it really quickly. Hey, if I can lose money, I'm not going to spend more time on this name. So I looked at any asset liquidation support, book value, tangible book value. There really isn't hard asset value here since it's a distributor. The book value is about $37.50 a share. The tangible book value is even lower at about $11.50 a share. And then the working capital, which is really the asset of this company, is really inventory and accounts receivable. It's $25 a share, but they do have some net debt of about $22 a share. So if you net all that out, you're only about $3-4 a share. So there really isn't liquidation support. The next thing I look at for intrinsic value, and the most important thing is what's the cash flow coming out of the company. First thing I look at is, hey, does EPS really, is that resemblant of free cash flow? In this case, it's about 92% there's a 92% free cash flow to EPS ratio. And the difference there is just the company consumes working capital as they've been growing. So overall, the EPS is reflective of free cash in this instance. If you're at the current price, if you're taking about $3.46 a share, you look at a 3-year average free cash flow per share at about $15-16, you're about 22 multiple. It's pretty expensive. If you look at the 5-year average, you're looking at $12.60 of free cash flow per share, which is a 28 times multiple. Now, Berkshire, they don't really look at forward forecasts. They usually look historically because those are real numbers. And so I'm using how would they look at it. And it looks expensive to me for that perspective. Now, if you think back at where the price was around this event, it was in the low 300s. I mean, it got down to 295, took an average price of maybe 315. That's my guess there. And if you take that same 3-year average number, you're closer to about 20 times price to free cash flow. More expensive than I would have thought Berkshire buy-in. They tend to look at 10, 12 times earnings multiples or free cash multiples. But it is a great business. They're just paying a little bit more for it. It is in a downturn, which doesn't come along a lot for the pool business. And then the other way to look at it is I also looked at this 315 price and said, hey, what's the peak they earned in free cash? It was $21. That was in 23, but there was free cash flow was higher because of the working capital release. Then it would be at about $15. But I think it'd be a stretch to call $20, $21 there. Normalized free cash flow earnings power at this point. If you look at it on a forward basis, which is how most people in consensus look at things, you'll look at using again the forward number of $13 free cash flow per share that's expected next year. At the current price, you're looking at 26 times price to free cash flow. If you think about the price in the low 300s, you're still looking at a 24 multiple. So I think it's a little expensive on price to free cash flow. So, then the other part is, what is the margin of safety here? The third thing I look at is the debt level. The company operates with low levels of debt. So debt to EBITDA historically been in the 1 to 2 range. It's currently at 1.25 times. So that's pretty reasonable. You're not going to lose everything, most likely, at this sort of name, but the debt level is reasonable. The next slide and this is the trickiest one that takes the most time and thought to really understand, is what is the stock worth? Is it below intrinsic value? So we used our model, and we did use a reverse DCF from our Insync custom model that we built to do this. So overall, the thesis on the stock is, hey, it's a great business. It's in a post-COVID downturn. It's simple to understand, and they've had consistent, profitable growth, and they have had strong returns, which speaks to their barriers to entry and their moat. So the historical value proposition, you're at about a little over 4% unlevered free cash flow yield right now. You're getting about 1.5% in dividend of that. And then if you look historically, the company has grown at the 10 to 20% earnings or free cash flow from 2016 to 2024. The free cash flow CAGR was 20%. And then if you look, the long-term guidance from the company, you always take guidance with a grain of salt, but the revenue is 6 to 9% and the EPS is 12 to 18%. So if you put all that together, you're saying, hey, you can expect to get 14 to 24% expected return from the current return on the current free cash flow yield of 4%. All that's coming back to shareholders, almost all of it in dividends and repurchases. And then assuming the company gets back to its historical growth rate of 10 to 20%, you're going to have a nice return. Now, that's the big debate here is what is the future growth rate? So we used a reverse DCF to say, what is the consensus value proposition? You're starting with the same free cash flow yield, a little over 4%. And then we use a reverse DCF where you essentially just change the terminal value to get the current price in your DCF, and you'll get about a 5 to 6% implied long-term terminal growth rate. So that gives you about a 10% expected return. And we also look at what is consensus expecting for revenue growth in the next 3 years, and that's about a 4% CAGR. Now, there's better flow through on that, so the EPS and free cash should be a little bit higher. But again, the consensus is thinking, hey, this is going to be a 10% expected return. That's what it's priced for. That's what most people, I think, in the market really are looking for in the large cap world, just to keep up with the overall market consistently. The Berkshire team's looking historically at what they've done, and they're saying, hey, eventually they'll get there. I know things are in a downturn, and there's a lot of short interest, and the industry is not doing great now, but there's no reason this company shouldn't get back to where they've been, whereas the street's like, things aren't great. We're just going to put in, maybe 5% growth until we start seeing a better turnaround. When you think about, what is Berkshire's potential variant view? No, I don't know. I'm trying to reverse engineer the way they're thinking. They're invested in a downturn. This is a great company in a downturn. It's also one of the few places where there is a downturn in the overall market right now. And if you kind of look at this 20-year chart of revenue growth, the only other time there was a downturn in revenue was 08-09. And then right now you've had a downturn in 23 and 24 with minus 10% and then negative mid-single digit growth in 24. Now that really comes after you had growth in the 20-30% range during COVID. So there was a lot of pull forward demand for pools. And right now you're seeing, a little bit higher interest rates, a little bit of people who were going to build a pool already did it. So you're having a downturn for various reasons. And you can also see here the forward numbers where you see consensus in mid-single digit revenue growth. The other chart I like to always look at here is a longer term chart of the company over the last 6 years and also the year-over-year revenue growth. So the interesting thing here is the stock price peaked at over $500 in the first quarter of 21, and year-over-year growth peaked at 55% that same year. So the stock, to some extent, has also moved with the year-over-year growth rate. One of the powerful things I found in my career is when a company changes from negative growth to positive growth, which is currently expected here by consensus, at least in the first quarter of 25, that could be a powerful thing that, hey, the bear thesis is not really playing out. The company's at least stabilized. They've gone from negative to stable to even positive. And that could always be a powerful thing, especially with a company with a lot of short interest. So I always do look at that year-over-year growth rate and if there's a change expected in it. That's not part of the Berkshire formula, but that is something that I've used throughout my career. So there is also a lot of short interest here. So that goes to, does Berkshire have a variant view? Are they being contrarian? There's over 3.2 million shares short. That's over $1 billion of value or 8.8% of the float. And I always like to understand what is the other side of the argument. So you could say the company is a little bit expensive on valuation. Their forward PE is about 29. Historically, it's been about 26. You could say, hey, there are concerns about a prolonged pool industry downturn. How do you really know if there's going to be a 2-year downturn or a 3-year downturn? I don't have any crystal ball to say, hey, next year is going to be plus 5%, minus 5%, or flat in terms of revenue growth. At some point, I think it'll get better with the overall industry dynamics. And then the third part is Home Depot recently got into the space by acquiring SRS. Now, this isn't new competition. They just kind of changed the name, but there's a little bit of concern about that. So you do look at overall short interest and say, hey, there's a lot of people betting against this stock. And you can also know historically, the short interest factor tends to be right if you look at it from a quantitative perspective like that. Now, the short interest has come down. It was about 4.5 million shares. Now it's about 3.2 million shares. And my sense is if the revenue does inflect to start going positive, there's a lot of buyers out there. My favorite CEO would say, I don't mind the shorts. They're guaranteed buyers at some point. So he's right. They're the people that will probably end up having to cover at some point. And there's no one who's a more nervous or aggressive buyer than someone who's short. So they're always a little frantic. And the other thing that's been weighing on the stock for the last 2 years, this is an earnings revision chart. Berkshire is buying into a stock that's had negative earnings revisions. One of the biggest drivers of stocks is earnings revisions and that momentum there. So we've seen revisions for the 24 number go from about $17 to currently $11 over the last 2 years. And that's what's been weighing on the stock here. Consensus is expecting about $11 this year. Next year, it's a little under 12. And then in 26, it's about 13.5. So this represents a forward PE of 29 times and about 25 times on 26 numbers. So in the near term or the medium term, I think the stock's going to move with the earnings revisions. But to the extent that we're done with the earnings revisions, that will cause a change in the thesis. You'll have shorts covering and buying, and then you'll have positive earnings revisions potentially. Now you have to get the whole industry dynamic there, right, on when pool spending increases. So, and here's just a historical chart of historical price to earnings and price to free cash flow multiples. I always like to look at those to kind of understand where we are in history. One of the most important things is also to look at, does this business operate in a good industry? Sometimes the industry can be more important than the company. And Pool is the largest wholesale pool distributor of pool equipment. And yeah, it's a very good industry and it's simple. It's mostly recurring revenue. The company breaks it into 3 segments. 62% is kind of maintenance business. There's 24% that is the replacement and remodel, and they've called that in the recurring bucket. You'll see this year that didn't end up being as stable as the maintenance and ended up looking more like the new construction piece, which is 14%, and that became a variant view this year. But for the most part, the industry has recurring revenue. The underlying base of pools has been increasing. There's currently about 10.7 million pools in the US that need to be maintained every year. Once you make that big investment, you're going to maintain it either yourself or through a pool contractor, most likely. And that number, that install base, goes up by anywhere from 50, 60, 100,000 pools a year. Now, right now, that number is down to about 50 to 60 new pools a year. And during COVID, that number was, 100, 120, whereas it was normally around 80 to 90,000 pools a year. So we're a little bit below trend right now. But, as people move to the suburbs, as people move southern, as people become a little more affluent, pools are growing a little bit faster than GDP. And also the customer base for pools, they tend to have a little bit of extra disposable income to afford this. It's a good business overall. And you'll see that in this company's return on invested capital. And one of the things I was able to do here to kind of really figure out the industry research is I used AlphaSense I used their Gen AI tool just to understand a lot of things about the industry, but I wanted to figure out how big is this industry, what's the installed base versus the pool construction of add in 80, 90 pools a year. And you could quickly find out, there's 10.7 million swimming pools in the US. And I was able to do that 15 minutes as opposed to having to read through a whole industry 10K, all the 10Ks and transcripts and spend half a day just trying to find this one data point. So really was super efficient using AlphaSense search here. And then, so we have a good industry. Then the question is, what about the business? Is this a bad, good, or great business? This is actually a great business. It has great returns and consistent historical EPS and free cash flow. The returns, the ROIC has been in the 20 to 30% for a long time, over the last 5 years at least, and even further back. The ROA has been over 20% and the ROE has been over 60%. Then the question becomes, hey, what's the pricing power of the company? And this is an important one. You go back to Berkshire and See's Candy, right? He bought the company. He's like, all right, you run it, but I'm going to be in charge of the pricing, because that was one of the most important things to determine the returns and the cash flow coming out of it. This company doesn't really have positive, I call it more, this company has neutral pricing power. It's essentially a pass-through model. When there's a lot of inflation during COVID and prices were going up 20, 30%, they were able to pass that through to their customers and to the wholesale pool service companies, and they passed it on to their homeowners and the pool owners. So it's mostly passed through. Now, there are times when if there's a little bit of an overstock, they do have discounts on equipment, or, if chemical pricing is going up or down, people might run to the other place, a competitor, to get a cheaper chlorine or whatever chemical they need to balance the pH of the pool. But overall, this company's also done a couple things to be sticky, right? They have technology where they're embedded with Pool 360 into their customers, and they also have the locations in the right place, and they have people there that service and actually know what you need for the pool. So that's actually pretty important. You don't want to just go, it's not a pure commodity. The service of knowing what you need is somewhat important as well. And then if you look historically, just, if you want to figure out if it's a good business, just look at the historical trends. That'll be the best indicator, right? Historically, their net income has grown over the last 10 years, about 18%, and their dividend payout, they've had excess cash, they've been paying it out, has grown even faster at about 19%. And you'll see that in the chart below. So that'll just tell you that, hey, they're a good company. They're able to grow consistently over time. And then we get into, does the company have a wide moat? Can they continue to earn great returns for a long time? And the way I tackled this was, I'm looking at the return on invested capital. They've earned 20% to 30% plus return on invested capital for a long time. So that tells me that it's a good business and people aren't competing away their great returns. It's sticky, whether it's based on location or customer service or just the whole industry is growing. They've been able to maintain their great returns. And also, because they are the largest in the industry, there are a lot of advantages from that. Their logistics and economics of scale, their ability to move inventory between locations. They can purchase things. They're the largest buyer of most of these materials or equipment from their supply chain, so they get the best pricing. They're buying the most stuff. And then they're able to spread their technology development of their Pool 360 app, which makes their customers sticky to them, for a larger base. So there are definitely advantages in that to being the largest, and you'll see that in the return on invested capital. And then the other part in terms of a moat is, they do have experienced employees. They mentioned on their analyst day that their team has been there 7-8 years on average, which is pretty impressive for a pool company where the average wage is about $50K and people move around a lot for a few bucks more. So the fact that I was surprised to hear that the tenure is that long. So they invest in their people and they have a good culture is what that tells me. Now that's something that has to be maintained by management over time. The other thing I look at is, their free cash flow generation and their capital allocation. If you want to look at, is this a great company? They've had excess free cash flow, and they've also been good allocators of that capital. 66% of their operating cash flow has been returned to shareholders since inception. About 45% through repurchases, 20% through dividends, and about 25% through acquisitions. They do a couple small tuck-ins a year. They did a relatively larger acquisition, Pinch a Penny, and they financed that with debt mostly a couple of years ago to get more into the retail space. But most of the money that they make goes back to shareholders. It's 77% of their net income has returned to shareholders over the last 8 years through dividends and repurchases. And you can see that in the chart on the right. They make a lot of money, and most of that gets returned to shareholders, and they lower the share count and they pay a dividend. So it's a pretty good thing. That's what Buffett always looks for, is sending the money back home to Omaha. And then for the long term, one of the most important things is, are management's incentives aligned with shareholders? I go back to the quote, show me the incentives and I'll show you the outcome, from Charlie Munger. You really want to simplify what your outcomes can be. Just figure out how is management incentivized. When you read the proxy, and I suggest you do at least glance at that, there's 4 metrics I'll hone in on 2. One is the return on invested capital, which is always good to see. And they have different tiers, but essentially they're compensated when the return on invested capital is over 10%. Which I can imagine that'll continue to be the case for the foreseeable future, given it's around 20% now. And that kind of prevents management from growing for growth's sake, and they focus on the return. And then the second one that I think is important is the 3-year EPS CAGR. The issue in the near term is going to be that earnings are now off a peak. And this is a a rolling 3-year EPS CAGR. So management's going to have a really high starting point for the next couple of years. It's important to see that. I'm curious to see how they manage that going forward. Now, the company, the current CEO, he's been there for about 6 years. Before that, he was the chief operating officer, and he came from a roof and supply company, which was heavy on logistics. And he's done well. He's kept the company in stride. And before that, there was a CEO who really built this over the last 20 years. He owns about 2.4% of the company. And this is a relatively simple business. The managers, I don't know. I've not spoken to them. I don't have a strong opinion about them, but I would put this in the category of a business. I don't want to say this in the nicest way, but it's what Peter Lynch would say is, a business an idiot could run. I'm sure these managers are top notch, but it is a business that it doesn't really matter too much who's running it, in my opinion, because the business itself is such a high quality. Now you're going to maximize the return and the earnings with a good management team and how they deploy capital. That is super important over time. And this company does have some good strategic initiatives, whether they're investing in technology, they're getting into irrigation, they got a little bit more into the retail space. They're trying to focus on commercial because they have the biggest footprint. It's a small part of the market. And there's also some other, they're not even saturated in terms of geography at this point. Dallas, for example, they were talking about they only have, I think, 4 centers, and they were so busy they could sell more services and densify a little bit there. Even in Arizona, they're not very large, and there's a lot of pools, obviously, in that warm climate. So there's more organic expansion opportunities ahead of them. And that's what you want mostly, because that will have a higher return on capital usually than acquisitions. And then I always like to look at the ownership table. I don't think Berkshire really cares at all who owns the stock, and they just care about what's the value and is it a good company and who's running it. But I always like to say, hey, Berkshire owns it. That's great. There's also a lot of other large long onlys buying what I consider quality investors. Wellington, American Century, JP Morgan, Kane Anderson. When I always pull up a holder list, it's always good to see someone like Wellington or American Century. These are huge funds that can continue to buy and support the stock if they like. And I also, when I looked at this, I also saw a couple things that were interesting as well. There were a couple kind of growthier private equity sort of funds that were selling. Bessemer, Bally Gifford, Select Equity Group. Now, you've seen some of these private equity funds have so much money, they've kind of gotten into equities a little bit. Public equities, maybe because the valuations are better. There's so much money in private equity. But I did find that interesting that they were exiting the stock at this point. And then the current CEO, he owns 0.2% of the company, 27 million. He's got a lot more, I think it was 50 million or so I saw on the proxy of value potentially of awards he could be issued. And then the former CEO owns about 2.4% and over $330 million of stock. And the other thing I thought was interesting here is the chairman has been on the board for 24 years. So you do see a lot of continuity, which is always a good thing. All right. So when we sum it up and we look at the Berkshire investment checklist, is the business in my circle of competence? Yes. What is the margin of safety? I didn't really see a hard value support there, so I actually gave that a negative rating. Is the stock available below the intrinsic value? I don't believe so. I was a little too pricey for me at 4% unlevered free cash flow yield. I understand if you want to believe it's going to grow at 10, 20%, then perhaps it is below the intrinsic value, but it wasn't attractive enough for me to give it a thumbs up there. Does Berkshire have a variant view? I think they do. When they look historically, you can easily make the argument this can grow 10, 20% again. There's no reason to think it won't. Versus the current market, I imputed that, to mid-single digit expectation. It's just a question of when does that happen. So they do have a nice variant view. Does the business operate in a good industry? Yes, the pool distribution business is consistently profitable and growing business. So yeah, it's a good industry. And is this a bad, good, or great business? I think it's a great business. I looked at the return on capital to judge that. I looked at the historical growth rates there as well. There just happens to be in a little bit of a downturn. Now we had a lot of pull forward during COVID. And does the business have a wide moat? This was a harder one to measure. Again, I looked at the returns, and they've had excess returns over 20% ROIC. So yeah, that tells me they do have a wide moat. Distribution and having that much inventory and supply chain isn't something you can just replicate overnight. It takes a lot of capital, and they have advantages in scale as well. And then our management incentives aligned. I did like the proxies seeing that return on invested capital and EPS growth are all in there. The management team seems solid, and that seemed like it lined up to me. So at the end of the day, is this one of your lifetime 20 punch cards? For me, at this current price, it's not. I would revisit it again closer to 300. That's likely what Berkshire did, and see if, it could be a little bit cheaper, but even 300 still on a price to free cash multiple is still relatively expensive. So this is a great company. I just think it's a little expensive for me. So I do not own it at this time, but I would revisit it in the future. And then when I was doing all this research, the second thing I want to talk about here is I want to kind of explain the research process of a varying view if I were in my other seat as a hedge fund manager, and what that research process would look like and how I would go about it, because this was a very salient example of how you can implement that to create an edge and enhance the returns of your portfolio. In February of 2024, on the fourth quarter earnings call, the company gave revenue guidance of flat to low single-digit revenue growth. Then in March, they had an analyst day, which they do every 5 years. And you can click the link. You should watch that if you're interested. It was about 3 hours. They gave their long-term growth rate of 6 to 9% and EPS of 12 to 18%. And they maintained their 24 guidance at the time. And they do, this company has historically had 30% gross margins. And then they have some SG&A leverage on top of that. And that goes back to the price and power argument from earlier that we could have elaborated on, saying, hey, the pricing's neutral. The margins have been relatively steady at 30%. They inched up here a little bit, and they could go a little bit higher as they do more private label, but overall margins around 30. So that they do have leverage from that revenue growth down to the EPS and free cash flow that doubles that growth. That was really what they were highlighting there. They went into a lot of details too on their strategy, how they service the customer better, about their specific initiatives, whether it's geography or commercial or technology as well on the analyst day. All right. And then in April 5th of 24 on the earnings conference call, they maintained their guidance, but they changed their language just a little bit. They said flat to slightly up instead of flat to low single digits. So that's a little bit of a telltale that things weren't going as well. They just didn't want to change the guidance yet because it was still early in the year. They want to see how Q2 plays out. Then if you were using AlphaSense and their TGIS expert library, you would have seen there was an expert interview done. And one of that expert indicated that pool leads are slowing. And what happened was in 2023 that they had enough backlog from 2022 that made 2023 a pretty strong year. Now, overall, 23 was still down 10%. They kind of blamed the weather. But now you said, all right, that backlog's off, and now the industry is going to be a little bit weaker. So we started to see another crack in that expert call on the 26th of April. Now, you had to be plugged into their network, the TGIS library or the AlphaSense library that's integrated now after the acquisition to discover that. Then there was another expert call on June 13th. And this one was even more telling. Now, this is going to be like the third crack, right? We had the slight change of language on the April call. Then we had the first expert call. Now we have the second call. And this call was saying, hey, remodel is now down with new construction. And if you go back to earlier in the presentation, you saw, hey, the company was saying 86% of revenue. So the expert interview indicated, so the second expert interview in June indicated not only did backlog not carry over from 2023, but that remodel activity was actually down with new construction. Now, this is contrary to what the company has typically described their business as being 82 to 85% recurrent, because they used to include that remodel business and maintenance business as a steady recurrent part of the business. But now what you're seeing is not only is the new pool business cyclical, but you're also seeing the remodel business down a good amount as well. So now you've got about another 24% on top of the 40% of the business that is seeing cyclical headwinds. And that's a little bit of a surprise versus what management has described their business as, and what most people believed the nature of the business being more recurrent with only a little bit of cyclicality, now having almost 40% of cyclicality in it. So now you've got three data points here that are saying, hey, things are probably, there's some signs. There's three flags that activity is softer. And then in June, on the 24th, the company pre-released their second quarter earnings and said sales are going to be down about 6.5%, similar to the year-to-date trends. They lowered their EPS by 19%. Stock was off about 9%, and then it was off about 13% within 2 weeks on the lower revision. Not quite as bad as the EPS guidance, because you did see a lot of people saying, hey, this is a great company, I'm going to step in. And you saw the buy-in from perhaps Berkshire or Wellington or those other companies. And then on the next call in October, it mostly maintained things, but there's a little bit of an increment there. They said new pool construction, instead of saying it could be down 15 to 20, it'll be closer to 20. So we're not quite out of the woods yet. So yeah, it was just interesting that you could use the AlphaSense in that library and just very quickly just pull up the transcripts and when I used AlphaSense here, it was really easy to pull up the calls. I typed in pool trends, and it highlights, not only does it bring up the expert transcript, it highlights it in there for you with bold black and red underlines of what makes it really easy to skim. You don't have to go find the expert. You don't have to go even call the folks at TICAS to go find the expert for you and call you back in 2 weeks. You just go to the library, and the information was right there. So this was one of the experts. He was a former business development representative and operations manager at Pool Corp. And then the other one that was really noteworthy was there's a general manager and a board member of a large swimming pool construction company talking about the renovation and remodel softness. And then one of the things that also came up during these calls was, it's what I call a lateral call, was they talked about a lot of high inventory in the channel. Now that affects Pool Corp, but it mostly affects their suppliers. Pentair, Haywood, Fluidra over in Spain, because those are the guys who, if there's too much inventory, the distributors are going to buy less, and they'll have cost absorption issues, or maybe they'll have to discount to move the inventory. And then one other thing that came up was that the fiberglass demand there's a company, Latham, that makes the pool shells for fiberglass, that was trending even weaker. So a lot of lateral trends from these expert calls that was super, super helpful. And with that, I will end the call, and feel free to give me a call or email me anytime. And I look forward to our next episode. Bye.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.